Welcome back to International Finance. I am Andy Kim, your Dr. Finance. Now, today we're going to cover the first half of Chapter 6 in Eun, Resnick, and Chulun International Financial Management 9th edition. It's about international parity relationships, and the first half of it is about interest rate parity. Okay, what is this about? Well, let me give you some motivation about this chapter. Okay, looking at the foreign exchange market and looking at the charts of it, right? Every second you see the fluctuation of the FX rate, right? US dollar price against Korean won, right? It fluctuates like crazy. And then is there any way, what's the driving force behind this price movement? Essentially, FX rate is about the price of other countries' currency. And there the numeraire or the denominator is my currency. Okay, based on my currency's unit, what's the price of other currencies, value, the price of other currencies in the country, right? So the price moves every second. Is there any way to figure out the driving force behind it? Okay, the dark force behind that FX, right? We're trying to learn about it. The key concept is international parity relations. The first thing is interest rate parity. The second thing is purchasing power parity. Okay, the interest rate parity, well, it's saying that essentially this is the interest rates of two different countries, relatively different interest rates, that is driving the FX rate, right? The money moves from one country to the next another country if the interest rate is more attractive, right? Over there, over here, right, moves. And accordingly, the demand for those currencies will fluctuate with this interest rates differentials, right? So that's the first concept that I try to understand. And then purchasing power parity is about the inflation rate. Okay, two different countries, well, their inflation rate may be different. Okay, some countries may suffer from hyperinflation. Other countries may go into deflation. Right? The purchasing power of those currencies is a key determinant in this FX rate. Okay. And a whole bunch of other things related to this two key concepts will be discussed in this chapter. And the chapter outline, well, interest rate parity, we're going to learn about it this week. There we are going to learn about covered interest arbitrage and IRP, interest rate parity, exchange rate determination, and then currency carry trade concept, which is about borrowing from low interest country and then invest in high interest currency in other country, right? You make money out of it. That's carry trade. Reasons for deviations from interest rate parity relations, we'll also talk about it. And then it's going to be about bid-ask spread and then those market frictions. And then we'll pretty much be done for this week. Next week, we're going to talk about purchasing power parity. It's about inflation, Fisher equations. If you remember your economics 101, microeconomics, right? Or macroeconomics together, right? That thing will bother you. Real interest rate versus nominal interest rate. And then what's the difference? That was the inflation rate, right? Assuming that your two different countries' real interest rate is the same, then the only thing different will be what? Inflation rate. And then these differences in inflation rate will drive the FX rate differentials. Right. That's purchasing power parity argument. PPP deviations. By the way, it's not PPAP. PPP deviations and the real exchange rate. Okay, and then evidence of purchasing power parity. We're going to talk about that. And Fisher effects. We're going to discuss. Then we'll move down to the final part of the chapter, which is about efficient market hypothesis. Why? Because you will be interested in forecasting FX rates. Okay, is US dollar going to appreciate or depreciate relative to Korean won, or relative to British pound, or relative to euro? Right? Who knows? Efficient market hypothesis says what? No way of predicting it, random walk. But there are some techniques, and then the people who are against this EMH, and then say you can predict and forecast this FX rate movement, the price movement of US dollar, right? Relative to Korean won. You can predict that using fundamental analysis, like head and shoulder, knees and toes, right? Kind of things, right? Or other approaches. That's technical approach, and fundamental approach is also there. Okay, so we're going to learn about those things and then see how it worked. Okay, remember, this is taught by or written by economists, and our economists, including myself, are under the domain of efficient market, school of thoughts. Chicago, Minnesota, Carnegie Mellon. If you have taken my behavioral finance class, right? You will hear this name until you get sick and tired of it, right? So in the end, it's going to be supporting more of a EMH story. But the guys in the industry may have different stories, right? Anyway, so introduction to IRP. Let's move down further. Okay. So some basic concepts I have to settle first in your mind, right? Well, it's about the international parity relationships that we will examine. Here are manifestations of law of one price. Law of one price, 일물일가의 법칙, they say. What the heck is that? Well, that must hold in arbitrage equilibrium. Okay. Arbitrage equilibrium, we are going to talk about it later. But this is about equilibrium concept. Equilibrium, what do you mean? 균형점. As an investor, right? You will have two different alternatives, okay? Two different investment options or investment tools, right? Two different investment tools. In equilibrium, you will be indifferent between these two. Okay, you will have two different ways of, investing in our IRP relations or PPPD relations, right? Two different investments. You should be indifferent between these two. That's equilibrium concept, all right? And then arbitrage equilibrium. It says, well, there should be no arbitrage opportunities in between these two different investment opportunities. You are going to see what that means in more concrete ways. Then law of one price. Either you call it LOOP or LOP, it does not matter. Law of one price, what is that? Assets that give you the same cash flows in the same states of nature should trade at the same price. Okay? And it precludes arbitrage opportunities. Right, there should be no arbitrage opportunities. And then law of one price, essentially, right? Essentially, if you are looking at let's say gold or coffee, should I say coffee, Brazilian coffee, the same place, right? Same quality coffee over here and over there, right? Brazilian coffee, let's say beans, okay, a cup of coffee beans, right? The same size, right? Okay. They should give me the same cash flow in one state of nature, like in an economic boom time. Their cash flow to me should be the same. In recession time, their cash flow to me should be the same. Okay? I'm not saying that these two coffee beans cups, their cash flow should be identical regardless of boom or bust in the economy. But what I'm saying is, in the boom time, their cash flow should be identical. In the bust time, their cash flow should be identical. Okay? as long as those cash flows in the two different states of nature are the same for this guy and that guy, these two prices should be identical. That's law of one price. Okay? So that's that. And two things that are equal to each other must be selling for the same price. 24K gold, 1 ounce, and another ounce of 24K gold, they should trade at the same price. London market versus French market, right? Paris market, right? Or Stockholm market, right? It should give me the same price, right? If not, you have arbitrage opportunities. Like what? Like Jim Rogers. What did he say? Buy low, sell high. Right. You buy it from the market that gives you a lower price of the identical asset, sell it at the same time, simultaneously, in that high-priced market. The thing is, there comes arbitrage concept. The act of simultaneously buying and selling the same equivalent assets or commodities for the purpose of making certain guaranteed profits. So, first of all, textbook arbitrage over here. It is risk-free. Okay, we are assuming it is risk-free. And then net cash outflow in starting point times 0. No cash goes out of your pocket as an investor. How come? Well, first of all, you short sell the high-priced ones, and then with that you collect the cash immediately upfront, and then with that cash, what do? Buy low. So that's why you don't need cash in the day 1, right, or day 0. You don't need any cash outflow. And then you lock in the profit, right? And then the market is in equilibrium when the profitable arbitrage opportunities exist, right? Market is in equilibrium when no profitable arbitrage opportunity exists, right? So this is the concept of arbitrage equilibrium, right? Now, having said that, if we move down, right, interest rate parity, we define it. It is a no arbitrage equilibrium concept. And then if interest rate parity did not hold, then it would be possible for an astute trader to make unlimited amounts of money exploiting the arbitrage opportunities, right? I mean, I remember, okay, in Bank of America, when I was working over there 20 years ago, in FX trading desk, there was a guy, doing FX arbitrage, right? 강수진 ballerina's husband, right? 강수진 ballerina. Anyway, making a lot of money. Yeah, I know. And then, since we don't typically observe persistent arbitrage conditions, we can safely assume that IRP holds. The thing is, most of the time, the thing is, once maybe you were lucky to identify those rare arbitrage opportunities, you could found out identical asset traded at different prices, right? What happens? Well, you short sell the high priced one, and with that you take a long position on the low priced ones. Then what happens? Two different markets, let's say. You take a short position, okay? You're selling it. So the supply of this goes up. The price goes down, down, down. And over here, you buy it. So the demand goes up, up, up. Together with it, the price goes up. Until when? They meet each other, right? So these arbitrage opportunities quickly disappear, okay? Now, mathematically showing interest rate parity relations. By the way, in CFA exams, this is one of the most popular or FAQ sections, right? So by learning this, you will be able to ace in your CFA exam quite easily. Anyway, IRP relations mathematically represented this way. S equals F times 1 plus I in pounds over 1 plus I in dollars. What the heck do you mean? Well, the formula itself. Well, S stands for spot exchange rate. F stands for forward exchange rate. okay? And then I stands for interest rate, and the subscripts stands for the currency that you are interested in. Okay, now forward exchange rate, you learned about it in previous section, right? Before. Forward contract, we are assuming that, right? Forward contract, it could be 1 month or 3 months or 6 months or 1 year or n different years, right? Going forward, it's a contract between you and other counterparty. Could be anybody, but in a large market. And then spot exchange rate. Let me state it clearly over here, right? This textbook is a US textbook, so it's going to be US centric. Please understand that. And then there, we are trying to quote direct quotation from American standpoint. So what's the price of British pound in terms of US dollars? That's this exchange rate, okay? Dollar per pound. Per pound, how much is it in US dollars, right? That spot exchange rate is shown over here. And then forward exchange rate is like 1 year down the road, okay? What's the promised exchange rate, okay? When you convert a British pound into US dollars. That's that guy. Okay. So what does this relation tell us about? Well, if you move down to the next picture, it's the way I understand it. All right. So I draw two different timelines. One in US dollar terms in the bottom, my home currency, let's say, right? Home currency, and then foreign currency on the above, right? Pound over here, let's say. And then we have two different time points, which is the first one is today, okay? And then the second time point is, well, 1 year from now, okay? In this example, let's say. And then in US currency, you have US borrowing and lending rate over here, US interest rate, I would say. US interest rate, 2% in this example. And then in British pound, right? 2.2% interest rate. Okay, let's say for the sake of our discussion. And it could be US Federal Reserve, Fed, what's that? The US Treasury rate, 1 year Treasury. And then British Consul, right? British Treasury rate over here. Same maturity, okay, same structure. And then what you have on the first arrow over here is the exchange rate from pound to US dollar. Spot exchange rate, $1.4 per pound. So the direction goes from here to pound to dollar. That's intentionally I drew it that way, right? The starting point of my currency is like always denominator over here. That's why. And then this guy, the direction, okay, is in the numerator. That's my convention. Not to confuse, right? And then here again, in the forward rate, you have this relation, X dollar per pound. We don't know what the heck that will be, but it should be, we will figure out what should be our forward rate that precludes any arbitrage opportunities, right? You have to be indifferent whether you go one way or the other. But what are those one way or the other? Well, we can think about, right, going this timeline in two different currencies, right, with your money. We can think about this way, okay? You start from here, okay, with some US dollar amount as a US investor. And then one way to invest your money is to put your money in the US Treasury, 2% rate in 1 year. And then this is the end point, you stop, right? So 2% you earn in US dollar terms, right? You stop over here. That's one investment opportunity. What's the other way of investment? Well, you first convert your US dollar into British pound at spot exchange rate, and then put it into British Treasury rate or lend it, okay? In Treasury rate, 2.2%. And then after maturity, you get the amount and then convert it at a promised rate, a forward rate, okay? So this is a second way of going. Okay, the first way and second way, you should end up with the same amount of money, right? That's the idea. You should be indifferent. You should end up with the same amount of money, whether you go from this way or that way. Okay? Convert first into British pound, invest in British, and then convert it back to US dollar, right? You should end up with the same amount of money as what you did in the first one. In this picture, you have two possible routes from go to stop. Why do you use go and stop? Well, because I am Korean, right? Go stop. Go stop is, Koreans' favorite gambling, and go stop, right? Like 눈이 시뻘개지게 이렇게. Anyway, so I could have said in and out, but go stop. Anyway, your exchange students, right? Your team members, Korean team members, make sure you guys do some kind of go stop with your international exchange students. Don't do it with your money, real money, but just as a fun. To teach them how to do it, go stop, right? Anyway, now both ways should give you the same return. Otherwise, there is an arbitrage opportunity. That's an idea. Now, how to figure out this forward rate? You did not give me the number? Well, the next slide, okay? So, lend money in US dollar, okay, and get 2% return. That is, at the end of the period, you will get $1.02 for every dollar invested. And then the second way, okay, is buy British pound in the spot market and lend Great British pound at 2.2%. Then sell Great British pound at forward rate, pre-promised rate, right? We just don't know this pre-promised rate that justifies this relation. We are solving for it. And then we are making these two, okay, making these two equal to each other. And then solve for F. That's this guy. Okay? Then you will do, right? Over here, 1 over S. Why is it 1 over S? Because we are initially at the spot market going to the other direction, whereas the spot rate is shown in this direction, from pound to dollar direction, but we're going the other direction. So that's why we are taking the reciprocal and multiplying 1 plus pound rate times forward rate. And that should be equal to 1 plus dollar rate. So if you solve for F, you will get 1.3973. Okay? Take a step back and look at this too. 1.4, 1.3973. Okay? There is a change in this rate. What will this mean? Wait for that.